Good morning, fellow traders. We are Wednesday, 29th of May, 2024. Welcome to the Flow Show. Ryan is going to be off for the next 3 days. So this is Cayman. I'll be your host for the next 3 sessions. Just kill my squawk here. So welcome, everybody. There's a lot to go through. But first of all, as you can see on my screen here, we're having this offer. We are not doing many over a year, but this is one where there's a bit of interesting stuff going on there, because if you buy a semi-annual or an annual subscription, you will automatically get entered for a free draw to get access to a 100K trader funding program account. So no time to waste. This is the moment to join our community if you're not already part of it. So we are looking forward to welcome you aboard very soon. Okay, this being said, let's move over to the data and whatever else has been going on overnight and this morning. So first of all, let's do it in the usual order. Let's move over to Asia. And well, the IMF, for what it's worth, has revised the Chinese GDP forecast for this year back up to 5% from the prior 4.6. Not that it impresses anyone in regards to the CNH, because that thing is still gradually weakening. The investors are still not on board with the Chinese revival story, even though that the cities over there loosened mortgage requirements for home buyers, but that's more on the local front. We know that geopolitically, the external relations between China and whoever else, barring Russia and a few others, are not really impressing anyone right now. So that for China. Moving over to Japan. So first things first, and I was on the wrong day here. So we had a couple of data out, and this household confidence, which moved up a little bit and sideways for the past months, has come ticked lower again. And that was not for the likings of Mr. Adachi, who made a reference to it, saying that they are not planning to go on a hiking spree, or at least not a fast one, because it could disrupt the corporate and household investments. So that was his little dovish side. He did say, though, that they may respond with monetary policy if the yen falls are prolonged. I don't know for how longer. They want to know whether it's prolonged or not, because yen has basically been weakening for 3 years, barring intervention and the one lower US inflation blip. At the same time, he also said that responding to short-term FX moves with monetary policy would affect stability. So give with the one hand, take away with the other. What the message is there, to me at least, is still a very slow Bank of Japan. Now, if between now and the next Bank of Japan meeting we would see a weakening of the yen, they may actually do something, but I'm not sure whether the market is expecting now for them to do anything, or at least not going in a way that would disrupt the market, which is an interesting thing, though, and I reckon that has held the dollar yen back from rising further overnight. Is that the Japanese JGB yields, and I'm going to show it, they are regularly ticking up, and it does look like the Bank of Japan is okay to let them go, because we may have expected the yen to weaken further overnight because of those yields elsewhere ticking higher, but it hasn't, and some may have to do with the Nikkei losing steam and with those Japanese yields ticking up. I'll have a look at those a bit later. Now, central bankers, there's another slew of central bankers that came out. One of them was Kashkari once more, and I think he must be paid by the word, because he is just babbling the day away nearly every day. So he confirmed again that he sees no more than 2 cuts in 2024. Others that also spoke, but I don't think a lot has been said there. Would have been Cook and Dali, if I'm not mistaken, but I haven't seen anything really significant coming out of them. Those who were a bit more interesting were ECB's not, and Holtzman coming out. Holtzman saying that the disinflation is underway. He now is siding on the Dove side of things, after having been the Uber hawk at the ECB, saying that he does not expect too many hiccups in the disinflationary picture, but he says 2 to 3 cuts maximum this year. So I think they're all on the same line for June, but then July still remains an open question. And Not was out as well with more or less the same line, saying that the disinflation is continuing. The policy rate will slowly and gradually move to a less restrictive stance. And based on the March projections, he now thinks that 3 to 4 cuts are possible this year. So he leaves the door open for that July thing. It did affect the euro just smalls when it came out, but what drove it more, and I'll have a look at those data, is this consumer confidence and those auctions influencing the market more, and this morning's German inflation data. Who else has been babbling? Oh yes, yesterday in Canada, the Canadian Finance Minister Friedland was on the wires, and she was saying that the budget that Canada put forward has created the conditions for the Bank of Canada to cut interest rates. Now, she did repeat that the Bank of Canada is of course independent, but we know, and we even know from Yellen, that the finance ministers now love to talk about monetary policy themselves, and so she is siding on the side of rate cuts now as well. Gentle wink at Stivers probably, but Rogers won't have liked this comment, because she's still a bit more on the hawkish side. But anyway, that is what she came out with, and I think for the news outside data, that is about it. One last thing, there was an article this morning in the FT talking about the people going to the Bank of England lending facility, and reporters are trying to make a thing about it, bringing up the shortage of cash word, but the Bank of England themselves have said several times that they would continue to do QE. Especially they want to create conditions where they, in case of a next crisis, they have the power to do QE again, and they will still roll off their bond buying. So they will still continue QE. If people want to go to the lending facilities, they will be welcome. I don't think when we look at the amounts that have been mentioned, 16 billion sterling, they could look to be a bit on the high side, but I don't think really for the time being we can start to talk or start to fear about a shortage of cash in the gilt market, in the UK bond market so far. So story to follow, but I don't think that we are there yet on the panic side of things. Right, moving over to the data and to what happened then yesterday. After the face show, then we had a bit of housing numbers, mixed bag here, nothing really that the market took note of. Then we had the consumer confidence coming out, beat And also the inflation expectations ticked up again 0.1%. So that gave the dollar a little bit of an initial lift there. And then we had a couple of auctions that didn't go well. The twos and the fives, they both saw tails of, I think it's 1 BP and 1.2 or so BP. People will correct me if I'm wrong. So that drove the US yields back up, and actually the yields in general, because even the European and the gilt yields ticked up on the back of it, but that gave the dollar a little bit of a little bit more support, and it also started to weigh on the equity markets. And actually, the equity markets are trading a little bit softer this morning. We'll have to have a look at what's happening in the S&P there, because we are trying to break a little bit of support. Moving on, we saw the Australian weighted mean CPI, one that the RBA is watching, ticking up 0.1% versus the prior, but especially 0.2% versus the expected. So we know already that the RBA is reluctant on cutting, and this should push them in the higher for longer scenario too. Looking at the Aussie picked up a little bit of steam on the back of it, but I'm going to repeat this over the course of the show and over the course of the next couple of days as well. We are in month-end territory, and it does look that the market is more trading on back of those things than really trading these numbers that we see, the data that we see. They may come into effect, I would say, after perhaps even month end. We may have to wait for month end to really see the effect of those, because this all the data that we have seen this morning, and then I'm going to move over to what we've seen in Europe here as well. They all have like a very limited impact, because the market is really rebalancing their portfolios now for month end. So that brings us to those data. Early doors, we had the German consumer climate that ticked up a little bit, but the French consumer confidence, they stayed the same, a tad weaker than expected. Bit of a mixed bag on the rest of the numbers. The Italian consumer confidence though ticked up, and that was a bit supportive at the time, small pips. And then we had all those preliminary German states CPI coming out. Now, as they came out, the market focused on what the month-on-month numbers were. So all of them are coming off, whereas we see this Brandenburg, by the way, is a wrong one. This is flat on the month-on-month, not 3%. That's a wrong reprint on the calendar. But Hesse as well, North Rhine-Westphalia as well. They're all lower than before. Saxony too, but then you see the year on years, they were all stubbornly high. So a lot of base effects at play here. So there was a bit of a sell-off in the euro on the back of those months, and then people starting to realize, hey, hang on a little bit, we are still sticky on the year on year. And actually, if you look at all those euro crosses, they are grabbing back what they lost on the outcome of the CPI, but after an initial move lower on the euro, we're all back, and in some even higher than where we were. I really think that in this low FX environment, low FX option volatility environment, and with the month end in full swing, it's very hard to trade data for more than the algo blip when they come out. So what's next on the calendar for today? Actually, not that lot. So on the basis of those lender coming out, we could see the same thing happening on the year-on-year numbers here. So a little bit lower on the month-on-month versus the prior one. But a sticky year-on-year, that may be exactly the picture that's coming out. That's what the states were telling us as well. For the rest, we'll go. It's not very active on the data front. We will have the Richmond and the Dallas numbers out. But again, I think the market will have a close look on what's happening on the 7-year note auction later today, because as we seen yesterday, those auctions weren't doing very well, and this could create another little bit of a blip in the yields if we would see the same thing. Now, it has to be said that past months we did have some auctions not performing very well, but then the next day the next auction doing well. So where the twos and the fives haven't worked, it's still no guarantee that the sevens won't work. Okay, so we really have to wait for it to come out. And that's about it for the rest of the day, guys. South African elections are on today, but we won't know any results before tomorrow. And yesterday we had the kind comments as well of our friend in South Africa, Matthew, saying that we may even wait for the weekend to have really real results, let's say. So that is one that I'm going to keep an eye on as well, because the market is kind of relaxed about the possible coalition that may come out of this election. And so the dollar rand is really doing quite relaxed, and actually coming down gradually again. So the thing is, basically, the market would like to see an ANC DA, I think it's the Democratic Alliance coalition. That would be okay. Then we will see what the South African Reserve Bank is going to do with all of that. So that would be what the market thinks is the more positive outcome. But anything with the old Zuma or the EFF coalition, I don't think is going to take really to be taken really positive by this market. So I am still of the view that we may run out of positivity, whether it's here or we need a break below 18 before. But I still think that we are going to run out of positivity sooner or later on the back of those elections. But that remains to be seen. That's the way that I'm looking at it in any case. So having a look at those yields then. So yesterday we saw this uptick in the twos, nearly back to 5%. We're still hanging around, not too far from there. Lost a little bit of steam, but those 2 and 5 year auctions have dragged the whole curve higher, because we see here as well that the US 10s as well have jumped higher again, and we are back into this zone here, 455, 460. That is always a zone that I like to monitor for further developments in the US yield. So that is one that I'm going to keep an eye on, and it could be affected by the sevens, later today. So that already ticked up in sympathy with the twos and the fives as well. Keep an eye on what's happening around here, 460 on the sevens. If the auction fails again today and we start to break above, we could see a bit of an acceleration on those yields. And I would say that somewhere that should support the dollar perhaps. But then again, we are month end, and month end comes with its own flows, of course. So now, having a look at this euro dollar. So we had, and I'm going to move on to the shorter term one. We had this move down here when the German lender CPI came out, and look what happened. We came right on that little channel. We even dipped below quickly, but now we are just back to where we were. And I'm going to show the crosses as well later, because that's interesting, because we're actually barring euro sterling, which is around where we were before. The rest of the crosses are actually trading higher than where we were before those CPI, and that's probably people looking at the year on year finding it a bit sticky. I thought also when I saw the month coming up, that would be good food for the ECB doves. But those year-on-year remain perhaps a bit too sticky for really the doves to start to push later next week, actually, on the ECB meeting for pushing for July as well for a cut. So for the time being, trade the algo blips on data. That's the only thing I can say. The rest moves are undone very quickly, and respect that little bit of a channel. I say like 35, stretch it to 30 perhaps on the euro dollar. We are trading value date end of month. So today we may see a bit of US corporate dollar shopping. So we may see a retest of that one. I actually thought that today we could see a bit of a break of that and get closer to 108, but I'm not going to look for much more, because if you look at our let me go back actually and pull that back up just for a second. Where is that? And I'm going to take you to the, where's my dashboard? Here. And I'm going to take you to the, no, here, this option pricing page. If you look at those options, we are still at very, very low levels in whatever dollar pairs are concerned. Yeah, the antipodians, but they are usually a little more volatile than the majors, especially that we had this Aussie CPI, but then they are not really overly high either. But you look at the euro dollar, for instance, you look at cable under 6%. You look at dollar CAD, for instance, close to 5%, diving under and ready to dive under the 5%. That doesn't testify of big moves. So I still think that barring the flows that we may see on month end, which, by the way, the models were calling for a decent dollar selling tomorrow and the day after. But if the S&P, and I will have a look at it, if the S&P mainly starts to come off on the back of those higher yields, those models may have to be revised, and there may be less dollars to sell. But for the time being, there's still what the models are saying. Cable, I find it pretty resilient still. I think it's one of those that if we still would see those dollar sales, we could this could do relatively well still, for as long as we hold somewhere that 127.20 for a starter. Keep an eye on what's happening at 128, because that's been rejected again. So you've got your range there. I think perhaps this is a bit too steep. This is too steep for my liking. So 127.20, 128 is the first range, okay? And then moving over to those crosses, and that was a bit. Whoops, what is this? Ow! How do I get back to a view? How do I kill this view? Oops, there we are. So we've had several attempts in the past 24 hours to break below 85, but it doesn't. Okay, and again, I'm going to go on the shorter time frame. This morning we had this little bit of a run down on the euro sterling, but we are already back to above 85. There still seems to be enough interest there to buy euro sterling below 85, and for as long I saw that this morning on the back of the data, bought smalls back when it came back to 90. I'm running a really small short, but I don't think I'm really going to keep much of it right now. Although I found the sterling being so resilient, I found euro sterling was looking heavy again, but again, under 85, this shows how big this level is. Again, under 85, I think it looks a little bit cold, and actually we are moving a little bit away again. Those are still small pips, but the euro is again very resilient, and I reckon we are seeing a bit of month-end flows perhaps into into hourly fixings because even the euro dollar is ticking up a little bit right now as well. And speaking about those euro crosses, yesterday we had a bit of a move down, and this morning in the euro yen, but it's all like yesterday we had a bit of a move lower. This morning we had a move lower on the German CPI initially, but if you look at it a little bit wider, this is very easily coming back. So for the time being, I don't know whether it's a delayed reaction or so, but for the time being, I mean, euro crosses, and I'm just going to run through them very quickly. Euro crosses are still very resilient. You know, I've been running short a little bit of this one as well on the euro kiwi, but this 136 35-ish, 35 is still holding, and look, we are already back nearly closer to 177. So testifying of the resilience of euro crosses right now. Euro CAD, same thing. We were trying a bit lower in the past few sessions, but we are bouncing. Okay, I always said this one was looking better than the dollar CAD. It looks like we are seeing bids below 148 still on the euro CAD as well. So that is an interesting zone perhaps to keep an eye on for those trading crosses. I think this euro CAD is an interesting one to monitor, especially those Canadian data on the perhaps the weaker side as well. Freeland coming out yesterday, and we have how long? We have Bank of Canada next week, guys, as well on the 5th. So those Canadian pairs are perhaps those that can see a little bit of perhaps of speculation into the Bank of Canada to visit to revisit a bit higher levels, lower levels on the Canadian dollar across the board. And then look at the euro Aussie is doing exactly the same thing. We are trying to keep below this 163 and a quarter line, but it keeps on bouncing back from the 162s. Okay, so that is still showing us that even the euro is still pretty resilient. I think a lot of this has to do with month end right now. So okay, so I'm not a big fan of the euro, but we cannot ignore that those euro crosses are bid. So I think for the short term, this is one that we need to keep an eye on, perhaps into Friday or so. Keep an eye on how those euro crosses react. Okay, other stuff. So we saw this Aussie blip on the back of that slightly higher CPI. But again, now it's losing steam again, and I reckon that has to do especially with those euro crosses, but also with the fact that S&P is coming off. And after the Aussie, I'm going to have a look at the S&P because I think we're on interesting levels here. So we have to know that those antipodians, the Aussie, the Kiwi, stuff like Norway, Swedish, they can be trading on the back, and even sterling trading on the back of risk, right? And we see this S&P coming down, so we have to be a bit careful here. I still think that we may find some demand on the Aussie anywhere between 66.20, 66 the figure. Okay, Deresh, I will into month end, but I'm not pushing the boat, so I'm long a bit both Aussie and the Kiwi still, but very cautious right now. I'm not going to keep them longer than into month end really. So this is not one that I plan to keep, but for the time being, for as long as those levels hold, I'm rather leaning to the positive side. But of course, this one could do damage to all these positive feeling on those currencies, like the Aussie, like the Kiwi, like sterling, even in some way. 52.80, we are back there, and I know a lot of people have like a lot of nice pictures on here as well, but I think It's just a level that you watch into even month end, If we would get a confirmation down below 52.65, I think we need to be very careful on how this thing is going to evolve into month end. Therefore, I'd say pay close attention to what's happening on that 7-year auction. Also on Friday we will have the PCE, of course, out. But in the meantime, keep a close eye on what's happening in auction lands for the that 7-year later today. So 52.80. Okay, this is your level that you watch. On the top side, we've seen now that they are starting to have trouble with this 52, 53 and a quarter zone. Okay, I think this is now a decent enough little level in between the where we are now and the prior highs to monitor. If it's still very impulsive, okay, this could still just be some kind of like, I don't know, flag triangle, whatever you want to call it, bullish stuff for as long as we hold even above 52.40, right? But keep those intermediate levels in mind if we move up again. And on the top side, I think 53, 70, 80 is going to be a big level here. 53.80, if that would go one day, I mean, I don't know what's going to stop it before 55. Okay, so some things may be looking a little bit ish here, guys. Okay, so pay attention to what's going on here over the next, I would say, 6-7 hours, and into the end of the month. Okay, and also don't forget that if this thing, and that's why I want to talk about it for the month end flows as well. If this thing continues to come down and we see a less positive month-on-month performance of the S&P, it will also reduce the need for dollar rebalancing sales, okay? Because the FX neutral funds, they look at this, and this, if it goes down, impacts their rebalancing needs to sell dollars. They will need to sell less dollars. So it could have an impact on expected month-end dollar moves as well. Metals, bearish. Okay, I'm going to take over what Blake and Gregor were talking about. I mean, they are not like really the correct lines, perhaps, but they talk about the bear flagging. It could be, and it could be that we need to correct a little more into month end. Therefore, I would pay attention to what happens in Asia, because we know that the Asian central banks, we know that the Asians have been really good buyers of gold as well. If they would stop to buy into month end, we may see a little bit more of correction, but by no means we can call this over yet, right? As I was already showing you, this little bit of a traffic zone here, 23.15, 23 and a quarter. I think it's already important enough, together with 23, because the trend line comes in now. It could be just enough already down there. Okay, I'm not going to call this whole thing over before really 23 goes. Then I would feel a bit more comfortable of saying like, okay, this is now the real correction that started. And perhaps we need to wait for the start of June, to know exactly what's going to happen. 23.65 top side, 23.65 the range for gold. If that goes, then we are probably going to push back up into the 23.70s for as long as that holds. Or if we try again 23.5 and we cap, then we may see already a little bit of a deeper move. The silver exceptionalism, I'm going to call it, because it really outperforms gold quite well right now, and we are really not too far away from those prior highs, but the levels are relatively relatively well defined, I would say. Recall this 31.5 was a bit of a target zone. We have been turning around. So I would look at 31.5. If we start to confirm below 31.40, perhaps we can have a look back at what's happening around 30. But for the time being, this is positive, right? So 32.5 is again the level. Then I have 33 and 33.5. Virtually every half a buck now, if I zoom out, virtually every half a buck, I'm going to have something. But the bigger one is going to be 35 bucks, and that is the big 61.8 of the whole move lower from 2011 down to 2020. If this is to continue, consolidate above this 50%, I think 35 bucks is going to be possible for the more medium term. And there, if we get there, that would mean that the central banks in the are in their cutting cycle. But as we know from the market and the expectations right now, I don't think we are in a major cutting cycle, or at least the neutral rates are going to be much higher than before. So if we get this move up to there, unless we get a blow off top back up to 40 bucks, I think I know people are talking about much more, but first things first, right? This is how trading goes. I think we may need to reflect on what's going on. Anything else, folks? Because I'm not kind of done for what I need to show today. I could move through a lot more charts, but it's not really useful right now. I think the yen tried to correct a little bit this morning when Adachi said perhaps that they could do something on the interest rate front if the yen continues to weaken, but then we immediately run into buyers. I think it's still got a lot to do with those yen crosses rather than pure trading the dollar yen. Okay, and that's about it for me for today, guys. So just to repeat, if you're not yet in our community, you can take advantage of that discount that we offer these days. So you can see here the offer is expiring the 2nd of June, and if you get into a semi-annual or an annual subscription, look, you can enter a free draw to win access to a 100K trading funding program. And with that, guys, I'm going to wish you a perfect Wednesday, and we speak to each other again tomorrow. Thanks for coming, and talk to you tomorrow. Bye-bye, guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.